Do you know this trader? His name is Munehisa Homa, the man who made over $10 billion in today's money, using nothing but candlestick patterns. I've spent months studying his original methods and trading philosophy, decoding how he used simple candles to predict price movements with incredible accuracy. And today, I'll show you the exact candlestick patterns he created and used, and how you can apply them too, to drastically transform your trading results. In this video, you will learn the secret method Munehisa Homa used to read market psychology, how to trade like Homa using the Marubozu candle, how to use the Tonkachi and Nagareboshi to spot trend reversals, how to use the Harami and Doji to join strong trends at the perfect moment, how to trade using the Sakata 5 method, two powerful day trading strategies combining ancient wisdom and smart money concepts, the Sansen, Tsutsumi and liquidity sweep trading strategy, the Sanpei Age, Tonkachi and fair value gap trading strategy. By the end of this video, you will be able to read market psychology through candlestick patterns, predict trend reversals before they even happen, use one of the most powerful trading methods in history. These strategies work for day trading and swing trading. It can be applied to all markets, forex, stocks, crypto, commodities, and futures. Before we get started, don't forget to like this video, subscribe to the channel, and hit the notification bell so you never miss the next trading lesson. Let's get started. Before we dive into the patterns themselves, let's start with the basics. What exactly is a candlestick? A candlestick is a visual representation of price movement within a specific period of time. It shows four key pieces of information: the opening price, the closing price, the highest price, and the lowest price during that period. The rectangular part of the candle is called the body, and it represents the range between the open and close. The thin lines extending from it, known as wicks or shadows, show how far price moved above and below that range. When the closing price is higher than the opening, the candle is usually shown in green or white, meaning buyers were in control. When it closes lower, the candle is red or black, meaning sellers dominated. So, in simple terms, every candle tells a story of a battle between buyers and sellers, who entered, who won, and who lost. And when you combine multiple candles together, those stories form patterns that reveal the market's next move before it even happens. The very first candlestick Munehisa Homa relied on was called Marubozu, which literally means a shaved head in Japanese. It's a candle with no wicks, just a full body from open to close, pure momentum, pure conviction. Homa once wrote, "When the market shows no shadow, it shows no doubt." In other words, when price moves from open to close in one clean direction, it reveals total dominance. No hesitation, no rejection, no confusion. To Homa, the bullish Marubozu was the market's way of shouting, "Buyers are in complete control," and the bearish Marubozu was the opposite, a candle that whispered, "Sellers have taken over the battlefield." Centuries later, this same principle still applies. A Marubozu candle often signals the start of a strong trend or the continuation of an existing one. It's not just a green or red candle, it's a visual expression of human emotion, captured in one move. Look at this chart example. The market was in a clear downtrend, moving lower step by step. Then it began to consolidate, forming several small candles. A pause in momentum where neither side had control. After that, price broke below the consolidation zone, continuing in the direction of the trend. It then pulled back slightly, and right at that point, a strong Marubozu candle appeared. Notice how this candle has almost no upper or lower wick, just a full body from open to close. That tells us sellers stepped in with total confidence, completely overpowering the buyers. As Munehisa Homa said, "When the market shows no shadow, it shows no doubt." And look at what happened next. The market dropped sharply, proving that this bearish Marubozu wasn't just another red candle. It was a clear message from the market. Sellers are fully in control, and the trend is far from over. Look at another chart example. Here, the market was trending upward, then it hit this level and reversed slightly before moving back up again. As price approached that same level once more, four doji candles appeared. Okay, by the way, a doji is one of the candlestick formations used by Munehisa Homa, and we'll cover it in more detail later in this video. A doji represents indecision, a moment when buyers and sellers are perfectly balanced and the market is waiting for direction. Right after those dojis formed, a strong Marubozu candle appeared, showing that buyers had regained control and confirming the continuation of the uptrend. Now, here's how Munehisa Homa would interpret this setup. The dojis reveal uncertainty, a battle between buyers and sellers, while the Marubozu represents a clear shift in dominance. In his view, that transition from indecision to conviction signals that the market will continue moving upward. And as you can see on the chart, that's exactly what happened next. The market kept pushing higher. But remember, the Marubozu isn't only a continuation signal. In certain contexts, it can also mark the beginning of a trend reversal, depending on where it appears in the market structure. The next candlestick Munehisa Homa used was called Tonkachi, which means the hammer in Japanese. It appears after a strong downtrend and signals that the market may be preparing to reverse. Homo noticed that when the market keeps falling and suddenly prints a candle with a small body near the top and a long, lower shadow, it shows something important. Sellers tried to push the price lower, but buyers came in and completely rejected those low prices. That long wick represents rejection and strength from buyers stepping back into the market. He described it by saying, "When the shadow grows long below, it is the voice of the market saying, 'The fall has ended.'" In simple terms, the Tonkachi reveals a change in sentiment. It's the point where the market tells you that the sell-off is losing steam and smart money might be entering. Today we call it a hammer or a bullish pin bar, and the psychology behind it is still the same. It shows rejection of lower prices and potential for a bullish reversal, especially when it forms at a key support or demand zone. Look at this real chart example. As you can see, the market was trending down, then it hit this level of support and reversed. After that, price moved down again, touched the same level, and this time a Tonkachi candle formed. This shows that sellers lost the battle against buyers and the market is now likely to push higher. And look at what happened next. The market went up exactly as expected. Now, let me tell you something important. We're not going to use Munehisa Homa's candles alone. We'll combine them with his Sakata 5 method, which takes candlestick trading to an entirely new level. But now I just want you to understand the anatomy and psychology behind these candlestick formations. Stay with me because later in this video, when we combine these candles with the Sakata 5 method, it's going to completely change the way you look at charts. Let's look at the opposite version of the Tonkachi, the Nagareboshi, also known as the falling star or shooting star. This candle forms after a strong uptrend and usually signals that the market may be running out of strength. When you see a candle with a small body near the bottom and a long upper shadow, that's the Nagareboshi. It tells a simple but powerful story. Buyers tried to push the price higher, but sellers came in and completely rejected those higher prices. The result is a candle that shows exhaustion. Buyers are losing control, and sellers are starting to take over. In his writings, Munehisa Homa described it beautifully. He said, "When a light burns too bright, it cannot last till dawn." What he meant was that when the market rises too fast and too far, it's often followed by a sharp correction. The shooting star is the market's way of warning you that enthusiasm has reached its peak. Look at this chart example. As you can see here, the market was moving down and created this key level of resistance. After that, price started pushing up again, testing the same level once more. When the market reached that resistance area, a Nagareboshi formed. This candle shows that buyers tried to push prices higher but failed. Sellers stepped in, rejected those higher prices, and took control of the market. According to Munehisa Homa's logic, this type of candle signals that the trend is likely to reverse and start moving downward. And look at what happened next. The market dropped exactly as expected, confirming that this Nagareboshi candle was an early sign of weakness at the top. So while the Tonkachi represents buyers rejecting lower prices at the bottom of a downtrend, the Nagareboshi represents sellers rejecting higher prices at the top of an uptrend. Together, these two candles form the foundation of Homa's understanding of market psychology: fear, greed, hope, and exhaustion, the same emotions that still move the markets today. Now, the doji was one of the most meaningful candles for Munehisa Homa. To him, it symbolized a pause in the market, a moment of calm after strong movement, where both buyers and sellers are unsure of what comes next. When the market opens and closes at nearly the same price, forming that thin cross shape, Homa saw it as a sign that balance has returned, even if only temporarily. He used to describe it as the market taking a breath before speaking again. This pause can mean two different things depending on where it appears. When a doji forms after a strong bullish or bearish trend, it often signals a possible reversal. It tells you that the side that had control is now losing strength, and the other side might be preparing to take over. In that moment, Homa would not rush. He would wait for the next candle to confirm whether the market was truly reversing or just hesitating. But when a doji appears inside an ongoing trend, it's a continuation signal. It represents the market pausing to gather energy before continuing in the same direction. This kind of doji gives smart traders an opportunity to join the trend, not at the top or bottom, but during the brief moment of balance before the next impulse. In modern trading, we see the same psychology play out. A doji near key support or resistance levels can be a warning of reversal, while a doji in the middle of a strong trend is often a sign of healthy consolidation before the next move. Homer's lesson was simple. Don't fear the pause, understand it. The doji is the market's way of saying, wait, watch. The next move is being prepared. Look at this chart example. As you can see, the market was trending down, then it started to consolidate in this area. Eventually, price broke below the consolidation phase, and if you look closely, you'll notice a clear Marubozu candle. This candle is an early signal that sellers are dominating the market and that the downtrend is likely to continue. Right after that, a doji formed. And that's important. The doji indicates a pause in the market, a moment when both buyers and sellers are balanced. If you know how Munehisa Homa interpreted these candles, you can read them exactly as he did and make smarter trading decisions. Here, the Marubozu tells us that sellers are in full control. The doji tells us the market is taking a short break, not reversing, just resting before continuing lower. That pause gives you an opportunity to join the trend. When the doji closes, that's the perfect time to re-enter the downtrend with confidence, because you understand the message behind the candle. And look at what happened next. The market continued to move down exactly as expected. Remember, we don't use the doji alone. For now, I just want you to understand the message it provides. Later in this video, we'll combine it with the Sakata 5 method, and that's where everything will start to make perfect sense. Look at another chart example. As you can see, the market dropped, then reversed, creating this support level. After pulling back, price reached the same support level again and formed a doji candlestick. In this case, the doji indicates a pause influenced by a possible reversal. So remember, the doji doesn't only represent a pause in the market, it can also serve as a reversal signal, especially when it appears at a key support or resistance level. And look at what happened next. The market moved up again, exactly as expected. Now, let's move to the next candlestick pattern, the tsutsumi. In Japanese, tsutsumi means to wrap or to engulf. To Munehisa Homa, this candle wasn't just a pattern, it was a message of dominance. When one candle completely covers the previous one, Homa saw it as a shift in power. The stronger side, buyers or sellers, had not only fought back but erased the previous session's emotion completely. He described it as, when one day swallows another, the market's heart has changed. In simple terms, a bullish engulfing forms after a decline. The green candle covers the body of the previous red candle, showing that buyers have taken full control. A bearish engulfing forms after a rally. The red candle swallows the previous green one, revealing that sellers have seized control. To Homa, the engulfing candle wasn't just about size, it was about emotion. It meant that one side's conviction had completely crushed the other's hesitation. He often combined the engulfing with key levels or after a doji to confirm reversals. What he called the market's confession. In modern price action, the engulfing pattern represents a clear shift in momentum, a signal that the market is changing direction or gaining strength. At the bottom of a downtrend, it indicates a bullish reversal, showing that buyers have absorbed all selling pressure and are ready to push the market higher. At the top of an uptrend, it signals a bearish reversal, revealing that sellers have stepped in and taken control. And when it appears in the middle of a trend, it often signals a continuation, confirming that the pullback is over and the trend is ready to resume. Homa's principle was simple. The market's past emotion is trapped inside the new candle. Now, let's move to the next candlestick pattern, the harami. In Japanese, harami means pregnant, symbolizing a smaller candle hidden within the body of the previous larger one. To Munehisa Homa, this pattern wasn't about pregnancy, of course. It was about containment. One day's price movement contained within another represented the market's hesitation before a decision. Homa saw the harami as a shift in volatility, the moment when the market's energy compresses. He wrote, "When the child rests within the mother's body, movement pauses, but strength is building." In simple terms, an inside bar appears when price trades within the high and low of the previous candle. It shows indecision and reduced volatility, but also potential energy. After a strong move up or down, the harami often signals that momentum is slowing and a reversal could be near. During an active trend, the same harami can act as a continuation pattern, a temporary pause before the next impulse in the same direction. Homer used this candle as an anticipation tool. When he saw a harami forming, he didn't rush. He waited for the market to break out of the mother candle's range. The direction of that breakout for him revealed the market's true intention. Let me now show you a real chart example. As you can see here, the market was trending down. Then it started to consolidate for a while, creating what we call a range-bound market. After some time, the market broke above the range, signaling a potential trend reversal. Right after that breakout, an inside bar formed. This candle represents a pause in the market, which is completely normal. After a breakout, traders are uncertain. No one knows yet whether this is a true breakout or a false one. Munehisa Homer viewed this moment as an opportunity, not confusion. For him, the inside bar after a breakout was the market's way of saying, wait, confirmation is coming. His approach was simple. He would enter once the inside bar breaks in the direction of the new trend. And look at what happened next. Once price broke above the inside bar, the market continued to move higher with strong momentum. Look at another chart example. Here the market is already trending upward and you want to join the uptrend, but you're not sure when to enter. Munehisa Homer provided a great solution for this situation: the formation of the harami pattern, also known as the inside bar. As you can see, this is the first harami pattern. You can plan your entry after the breakout because the harami represents indecision and the breakout confirms that the trend is continuing. Then, notice the second harami pattern that forms shortly after. It gives you another opportunity to join the trend with confirmation. Now look at what happened next. Once those inside bars were broken, the market continued moving higher, perfectly in line with the dominant uptrend. Now that you understand the key candlestick patterns Munehisa Homer used, let's move to something much deeper, the system that combined them all, the Sakata 5 method. It's built on 5 core principles that describe how every market moves, from accumulation to trend, from exhaustion to reversal. Homer called these the 5 laws of Sakata, and they are San Zan. This is the origin of what we call the triple top. It signals that an uptrend is losing strength as the market fails 3 times to break higher. For Homer, this was the market's way of saying the climb is over. Look at this chart example. Here the market is trending upward, which means buyers are clearly in control. But then we can see the market forming 3 consecutive tops: the first top, the second top, and the third top. This is what Munehisa Homer called Sanzan, which literally means 3 mountains. Okay, according to Homer, this formation tells us that buyers have tried 3 times to push the market higher, but each attempt failed. It shows exhaustion, the point where bullish momentum starts to fade and sellers begin to take control. And look at what happened next. Just as Homer predicted, the market reversed after the third peak, confirming the Sanzan pattern. San-sen, the opposite of Sanzan. It's the triple bottom, a sign that a downtrend has reached exhaustion. When price forms 3 clear lows and fails to push lower, Homer saw it as the rebirth of buyers. The river has reached the sea and will flow no more downward. Look at this chart example. The market was moving down and then formed the first bottom, the second bottom, and the third bottom. This formation indicates that sellers are no longer able to keep pushing the market lower, which signals a potential trend reversal. For Munehisa Homer, this pattern, called San-sen or 3 rivers, was an early sign of a new uptrend and often used as an entry point to catch the beginning of a bullish move. And look at what happened next. As you can see, the market went up exactly as expected, confirming the San-sen pattern. Sanpei literally means 3 soldiers. It refers to 3 candles of the same color moving in one direction, showing strong continuation momentum. There are 2 variations. Sanpei Age, also known as the 3 rising soldiers pattern, consists of 3 consecutive strong bullish candles that appear after a decline, signaling either a bullish reversal or a continuation of the uptrend. Sanpei Sagaru, also known as the 3 falling soldiers, is a pattern made up of 3 consecutive strong bearish candles appearing after an uptrend, signaling either a bearish reversal or a continuation of the downtrend. Homer used this to confirm that a new trend was underway. When soldiers march in the same direction, the victory is near. Sanku, 3 gaps, represents market exhaustion. When the market forms 3 consecutive gaps in the same direction, it indicates that the move has become overextended. Homer warned traders to prepare for a reversal, saying, after the 3rd gap, the army runs out of breath. Sanpo is a continuation pattern. It appears when the market trends strongly, then pauses with a series of smaller candles such as inside bars or dojis, before continuing in the same direction. Honma used this formation to add to his positions, saying, "The warrior rests, not retreats." What makes the Sakata 5 method so powerful is that it connects candlestick psychology with market structure. It teaches you when to enter, when to hold, and when to prepare for reversal, exactly how Honma built his fortune. Now let's move to the first trading strategy, where we'll combine the ancient wisdom of Munehisa Honma with modern market dynamics to build one of the most powerful and precise trading setups you can use today. In this strategy, we'll apply the second law of the Sakata 5 method, Sansen, which is the foundation of what we now call the triple bottom pattern. This principle shows us how the market exhausts its selling pressure and prepares for a complete shift in direction. To make this setup even stronger, we'll add one of Honma's most reliable candlestick signals, the Tsutsumi, or engulfing bar pattern, as our main confirmation candle for entry. And finally, we'll integrate a modern smart money concept, the liquidity sweep. This advanced confirmation tool helps us identify whether a reversal is genuine by showing that the market has first swept liquidity and trapped sellers before moving upward. This combination, Sansen, Tsutsumi, and liquidity sweep, bridges the timeless market psychology of the 18th century with today's institutional trading techniques. We'll be using this strategy on the 5-minute time frame for precise entries, while a higher time frame will be the 30-minute chart, giving us both structure and context. Let's get started. This is the US dollar, Canadian dollar 5-minute chart. The market was trending down, which means sellers were in control. Then the market formed the first bottom, the second bottom, and finally the third bottom. This is what Munehisa Honma called Sansen, the three rivers pattern. It's an early sign of a potential trend reversal and reveals the market psychology. Sellers are now struggling to keep the market moving lower. Next, let's apply one of our modern technical tools, support and resistance. As you can see, the market has touched this support level 3 times, making the structure even clearer. But we won't enter just yet. The markets have evolved, and institutions are now active participants. We need more advanced confirmation before executing a trade. Now, look at what happens next. The market breaks below the Sansen structure but then closes back above the support level. This move is a textbook example of a sell-side liquidity sweep. Here, we combine Honma's ancient insight with modern smart money logic. The Sansen tells us sellers are losing strength. The liquidity sweep tells us large players have just triggered stop losses before pushing price higher. At this point, we can enter on the candle that closes above the support level. If you're a more conservative trader, you can wait for a candlestick confirmation. And right here we get it, a clear bullish engulfing bar confirming that buyers have taken control and that the market is likely to continue upward. Now let's do a quick top-down analysis. On the 30-minute chart, the market had been moving down, but it reached a major support level and rejected it sharply. Another strong sign of a possible trend reversal. That aligns perfectly with our setup on the 5-minute chart. Back on the 5-minute chart, here's how we'll execute the trade. Entry: at the close of the Tsutsumi candle. Stop loss, just below the liquidity sweep. Target: the next major resistance level. Now look at what happened next. The market moved up directly to our target, exactly as expected. I'm a big fan of the set and forget approach. Once you place your trade, close your laptop and let the market do its work. But if you prefer to monitor the trade, Honma also provided patterns that can reassure you. As you can see, after our entry, a Sanpei age formed. This is one of the strongest signs of trend continuation. Another Sanpei appeared here, and another one here. These repeated formations confirm that buyers remain in full control and that we made the right decision. Now let's move to the second trading strategy, which combines 3 powerful elements: Sanpei age, Tonkachi, and the modern fair value gap concept. This strategy will be used on the 5-minute time frame, and it works across all markets: forex, crypto, and stocks. It perfectly blends Honma's ancient wisdom, which reveals market psychology, with modern order flow principles used by institutional traders today. Let's look at the setup. This is the New Zealand dollar US dollar 5-minute chart. As you can see, the market is clearly in an uptrend, moving in impulsive waves followed by retracements. An impulsive move, a pullback, another impulse, and another pullback. Here, we can identify 3 consecutive bullish candles which form a clear Sanpei age pattern. According to Munehisa Honma, this formation shows that buyers are dominant and that the market is likely to continue moving higher. Now within this Sanpei age, there's also a modern concept at play, the fair value gap. We can spot one fair value gap inside the Sanpei age pattern, and another one slightly above it. But remember, we always focus on the last fair value gap during a move because it offers lower risk and stronger confirmation. Watch what happens next. The market pulls back, and once price reaches that final fair value gap, it gets rejected, forming a perfect Tonkatchi candle. This candle tells us that sellers attempted to push the market down, but buyers stepped in and absorbed all selling pressure. For Homa, this was the market's way of saying the retracement is likely ending, and a new upward impulse is about to begin. If you understand fair value gaps, you know this Tonkatchi is not random. It's a market response to the imbalance, which makes it a valid confirmation signal. Before taking the trade, let's check the higher time frame, the 30-minute chart. There we can see the market was trending upward, then consolidating, and recently broke out of that consolidation phase, starting a new bullish leg. This supports our 5-minute trade idea perfectly. Now back to the 5-minute chart. Here's how we execute the trade. Entry, at the close of the Tonkatchi candle. Stop loss, just below the fair value gap. Target, the next key resistance level. And look at what happened next. The market moved exactly as expected, reaching our target with precision. This setup shows how combining Homa's ancient patterns like Sanpei Age and Tonkatchi with modern concepts like liquidity and fair value gaps can create powerful, high-probability trading opportunities. If you learned something new, make sure to like, subscribe, and turn on the bell because in the next video we'll go even deeper into smart money trading using Homa's principles. Thank you for watching and see you in the next video.